Hi friends, Simit here from InformedTrades.com. In today's video, I want to talk about the price to free cash flow ratio, also the price to operating cash flow ratio, what that means and how traders can use that to find investment opportunities. Let's get started. Okay, key points. Cash flow is seen by some as a better measure than earnings. It's more indicative of how a company is actually doing, how much money it's making. There's two types of cash flow measures. There's free cash flow, which we'll refer to as FCF, and there's operating cash flow, OCF. We'll get into the exact differences of what they mean, as well as how they're calculated. The calculations get a little detailed and nuanced, and some people calculate differently, so that's also something you want to have a solid understanding of if you plan on using this indicator. Some evidence suggests that top free cash flow generators do outperform the market, which is a pretty significant fact. We'll get into how you can use this as well, talk about screeners, the specific screeners that I'm using, as well as how is it used in general. What are some thoughts from successful investors on how to use this this indicator, the price to free cash flow ratio, price to cash flow ratio. Okay, what is cash flow? Now, it's basically, and the simple answer is an attempt to measure how much cash a company is truly earning from its business. Okay, so it's really how much cash is coming in minus how much cash is going out, how much cash you have left. That's sort of what you're looking to measure. Now, the equation for this, and this is the equation for operating cash flow, which is mainly what we're talking about here. Cash flow from operating activities equals, you take your revenue, you subtract your cost of goods, you subtract your operating expenses, which might be like the overhead expense, you add back in any depreciation, and you subtract your taxes. And we'll go through an example of this with a similar or a pretend business shortly. That's the basic idea behind cash flow. Now, when you want to measure the price to cash flow ratio, you take the market capitalization, which is what you're paying, what the company is worth. What would it cost to buy the entire company, to buy every outstanding share of the company? The market capitalization divided by the cash flow from operating activities. And that gives us our price to operating cash flow ratio. Free cash flow. Free cash flow is regarded by many, and I must admit my bias here. I'm definitely more interested in free cash flow than in operating cash flow. I sort of ignore operating cash flow in my screening and focus on free cash flow. And it's a bit of a more refined measure. Free cash flow equals revenue minus cost of goods minus operating expenses. So far it's the same. We're taking the revenue, we're subtracting the expenses. That's just like we did in operating cash flow. However, we are subtracting changes in working capital as well as changes in capital expenditure. Now, working capital is equal to current assets minus current liabilities. What that means is basically current assets are assets that can easily be turned into cash. Current liabilities are liabilities that are quickly due. So we're factoring in how much, if you have customers that are going to pay you, accounts receivable, versus payments that are due soon, accounts payable, we're factoring that information in. So really free cash flow, and we're also taking out capital expenditures. Another simple way of looking at free cash flow is we're trying to get an idea of, after all the expenses are accounted for, how much free cash flow is left over. After all the capital expenditures, so if we have to buy a new building, we do that, which is not really related to cost of goods. It might not be an operating expense. If we're investing in the future, it's not really an expense. We're investing in a new line of business. We still want to factor that in and then see how much cash flow is left. If our customers are paying us off, or if we're recording a lot of revenue, but the customers say, oh, we're going to pay you later, a year from now, 5 years from now. Well, we want to see how that's impacting our cash flow. So we may be recording a lot of revenue, but if the customers aren't paying us, we're not getting that cash flow. And that's where I really like free cash flow. It truly measures how much cash is coming in. Okay, and same idea where if we're trying to get the ratio of price to free cash flow, we want to take the market capitalization, which is the entire, the entire worth of the company, what it will cost to buy every outstanding share, divided by the free cash flow. And here's sort of an idea of visualizing this. Free cash flow is basically a more refined, a stricter measure than operating cash flow. Both of them are trying to get the same idea of how much cash is coming in versus how much you're spending out. So how much cash is truly generated from the company's operations. And this, like I mentioned, I like free cash flow because it's more strict. It accounts for capital expenditures for growth. It does a better job of factoring in accounts receivable and accounts payable, so payments that may be due but aren't coming in yet or haven't come in yet. And here's sort of visualization. You get your revenue, you have your cash in hand, you take out your outflow. You want this, ideally, you want the cash flow to be growing. Or if it's not growing, you want to understand why, and you want to be confident that it's not a problem. And you want to understand the ratio between price to cash flow. If you are using this indicator, you understand the ratio to see if the cash flow you're paying for is that a good price. So an example of a free cash flow calculation. This can get pretty tricky and involved, so an example might help. Let's take a simple example of a lemonade stand. And free cash flow, because there's a change in net capital, it helps to consider two time frames. So let's say in the first quarter of a year, this sample lemonade stand generates $25 in revenue. Let's say they're selling it $1 a glass, and they sell 25 glasses. Okay, cost of goods, they have to buy the lemon, the sugar. That's $5. Okay, so the lemon and sugar and maybe some paper cups, you factor that in for what's it cost per, the marginal cost of generating a cup of lemonade, that's $5. Operating expense, maybe they need to put a sign up inside, or maybe there is, the lemonade stand operator is sharing some money with their neighbor who's assisting or their sibling or whatever. Operating expenses are $10. Now, working capital is $6, and working capital is the receivables minus the account payable. So maybe they bought sugar from a neighbor, but they haven't paid for it yet. So they owe their neighbor $4. And maybe some customers said they don't have the money now, but they'll pay them later, so their customers owe them $10, so they have working capital of $6. And then capital expenditures, let's say they want to set up a lemonade stand next door, or another lemonade stand, and they're going to put $5 towards the initial sign for that lemonade stand. Okay, so that's sort of Q1 operations. Now, Q2, $40 in revenue. Business is booming. Cost of goods is $8, buying the lemons, the sugar, the cups. Operating expenses are $12. Maybe they, need to pay for lights or something to operate at night. Working capital. They've paid off, as you can see here, they've paid off their accounts payable, so they don't owe anyone zero. They don't owe anyone anything. But more and more customers are saying they'll pay later. So receivables are $20. Okay. And capital expenditures, they continue to invest in a new lemonade stand. That's $10. So the Q2 free cash flow, we take the $40 revenue, we subtract the $8 cost of goods, which is the lemons and the sugar and the paper cups, minus the $12, which is operating expenses, maybe paying for having light or candles or something to operate at night, and the change in working capital. So as we saw in Q2, the receivables, they have more customers that owe them money. They paid off their debt, so they have $20 working capital. But Q1, they had $6 working capital. So we see working capital is growing. So we subtract that because they're recording the revenue. The receivables, that's the big issue here. The customers that say they're going to actually pay later, that's recorded in the revenue, but they haven't received that money yet. They're going to receive it later. So those receivables are growing. We're going to subtract that out because they haven't received cash for it yet. So that means the change in working capital, 20 minus 6 is 14. We are subtracting $14. And then we also had $10 in capital expenditures, so minus 10. So if you just looked at revenue and operating expenses, or revenue and cost of goods, you'd think this business was doing great. And in some measures, it may still be doing great. However, on a purely free cash flow basis, this company has a negative free cash flow. So I think it's an interesting example. It's not always a problem. If the company has a lot of cash to begin with, then they might not need to earn cash flow every single quarter. They may not have the backup against the walls. If they are very confident that their customers will pay, if all their customers have outstanding credit, then they also don't have to worry, and this might not be an issue. So there are things to consider when you're evaluating free cash flow. Personally, like I meant, I think it's a really strict measure. You want to see companies, or I like to see companies, especially as a value investor, that have a really solid business. You know, the company can invest in future growth. Their customers are paying them. There's money left over even after accounting for depreciation and working capital changes and planning for the future through capital expenditures. Even after all that stuff, there's still free cash left over. To me, that's a really great situation to be in. And if the price to free cash flow ratio is low, then I might be able to buy that cash flow at a pretty discounted rate, which I think is a pretty interesting opportunity for value investors. So hopefully this example makes a little bit of sense. It can get, there's a lot going on, a lot of moving parts to this calculation, but hopefully you can see why it's as detailed as it is and the value of it. Okay, price to free cash flow ratio can signal outperformers. So here's a chart. This is by fatpitchfinancials.com. It goes back to 1995, so we're looking at a 20-year period, and we're looking at the by quintile price to free cash flow ratio versus the S&P 500. And we're seeing that the companies with the best price to free cash flow ratio are outperforming the S&P 500. So that's something that's pretty interesting, and that fact alone may make you want to, find those companies. And one way of finding them, or that introduces us to the idea of screeners, which we'll get to in just a moment. Okay, one last thing, like the PE ratio, price to free cash flow ratio is good for industry analysis. If you have decided based on top-down analysis that you want to invest in gold mining companies, you want to invest in consumer retail, whatever industry that you think is growing, you can find sort of the value deals by looking for the low price to cash flow ratios in that industry. You can also find companies that are less likely to crash. Companies that are generating a free cash flow, they have that cash coming, they're less likely to crash. If you're concerned about a market crash, you may want to shift more of your portfolio into companies that are generating lots of cash flow, that are positive cash flow. So that's another way of using this indicator. And lastly, you can invert the ratio, make it free cash flow over price, to compare it to bonds. For instance, if bonds are yielding 1% or a fraction of a percent, or in some cases -% in our current environment, what are you paying for the free cash flow? If price to free cash flow is 10 to 1, then free cash flow to price means 1 to 10 or 10%. Well, it may make sense to invest in that free cash flow relative to the bonds that you're getting, or the yield on bonds. Or you may want to understand what's the risk premium. If free cash flow from bonds, which is guaranteed, you're getting 1%, 2%, you may say, well, I need at least 5% on top of that. I want to see 7% free cash flow to price to justify the risk of investing in a stock. Okay, now that we've sort of established that price to free cash flow ratio has some predictive value, or historically has been indicative of companies that tend to outperform the index, we can screen for those. Or that can be one strategy if you're interested in using this indicator, screening. Or if you're interested in using a lot of these valuation indicators, screening is going to be a key part of your activity in terms of finding what stocks meet those criteria that you're looking for. Guru Focus is the screener I use. It is a premium product. It runs at about $350 a minimum for a year subscription. So it depends on, there are other screeners out there. Google Finance has a free screener. But it depends on what you're looking for. Guru Focus, in my opinion, has the biggest range of accurate data that I've come across by a pretty wide margin. It is only for fundamental screening, though. So if you want to screen based on technical criteria, this really won't satisfy your needs. And we have a extensive screening section. Screening comes up a lot with traders, so there's a lot of information on this on Informed Trades. Just an example of the Guru Focus valuation screener and sort of how I use it. On this screen right now, after you log in, you can sort of specify what you're looking for. Market cap is something a lot of people look for. Industry, you can specify. Country is default USA. Their pricing package works on, it costs more if you want to add more markets, but you can screen the world, which is a pretty valuable thing, especially in today's global markets. Then you just click on this tab, Valuation Ratio, and here's where you see price to free cash flow. And you can even do it, show me the top, take it back. Show me, the top 50 ones with the best price to free cash flow ratio, or the bottom 50, and you can sort of set your screen from there. And you can, of course, mix and match it with other things. Show me companies that have, that are have the best in the top bracket of their price to free cash flow ratio and are in the technology industry and have a market capitalization of $1 billion at least. Have a price to book ratio of 3 or lower. Have a Schiller PE ratio of 15 or lower, whatever. So there's lots of criteria you can add. You can sort by insider trading and all that stuff. But in terms of price to free cash flow ratio, you can get a basic list here. You can see what the price to free cash flow ratio is right there. Here we're looking at the top 50, and updates pretty quickly. You can get your indicators, and then you can sort of go from there. It gives you a basic list to research from and develop your trading strategy. And that's about it. Price to free cash flow, price to operating cash flow. It's a pretty rich topic. There's lots of ways you can use this. It can be a very meaningful indicator for value investors. Any questions you have, anything you want to add, join us at informedtrades.com. Best of luck in your trading, and we'll see you next time. Take care.